Chapter 9, Part 1, Allocation of Indirect Costs. We're going to look at return on investment, residual income, profit margin, and investment turnover. These are all ways that we can evaluate parts of our company. Now, one of the things that happens in a large corporation is we like to break them down into parts because they're much more easier to manage. So we call these responsibility centers. Now we can have three types. One would be a cost center. An example would be admin. Admin benefits the whole company, but those costs need to be allocated to the divisions that benefit from their services. So they collect the costs, and their goal is to budget and control their costs. That's all they're responsible for. Profit centers are evaluated on their success in generating income, and investment centers are evaluated based on their use of assets to generate income. In decentralized organizations, decisions are made by unit managers, and top management evaluates the performance of the unit managers. So, responsibility center is part of an organization whose manager, that's misspelled, is accountable for planning and controlling activities. The responsible accounting is the system for evaluating performance of each responsibility center and its manager. So, the problem you have as a manager is you have two things. You have what we call controllable costs. These can be controlled by the manager themselves and the department, like how many supplies they use. Uncontrollable costs are things that they cannot manage, and these are called usually allocations. Now, when we talk about costs, again, we use the word direct expenses a little differently. These are all costs associated with a specific department. So, if we rent a building and it's only used by one department, that would be a direct cost for that department, even though we know that that is really a fixed cost, but here it is a direct cost because we can trace it right to the department. Indirect expenses are those expenses that benefit multiple departments and cannot be traced to one department. And the question becomes, how do you allocate those costs? Okay. And the way we do it, there's two ways we can do it. We can use a single basis, but that not always the best way, particularly if departments use different elements of those indirect costs differently. Or we can use multiple cost drivers. So again, here's how it works. When you have a service department, it's called a cost center, which would be like the purchasing department. We would collect all their costs and allocate them to the various operating divisions or profit centers. And then what would end up happening is then the question becomes, what causes those costs to change? So, for the service department, we collect their direct expenses plus any allocated expenses, and then we turn around and allocate that to the operating divisions. So let's take a look at an example. Aaron has two departments, indoor furniture, which uses 2,200 square feet, and outdoor furniture, which uses 1,800 square feet. The indirect costs include rent, advertising, and insurance for a total of $80,000. The company occupies 4,000 square feet of rented building. The company can allocate the indirect costs based on square footage and based on a total indirect cost rate of $20 per square foot. How much would be allocated to each department? So, for indoor furniture, of the 80,000, they get 44. And for the outdoor furniture, they get 36. Now, my thing, make sure you always add those up to make sure they equal the total of 80,000, which is the amount we're showing. Now, what happens if instead we decided to use 3 methods? We go ahead and allocate the rent based on square footage, the advertising based on sales dollars, and insurance based on the value of the insured assets. How would this amount be allocated differently? So, the $45,000 for rent, we would do that based on square footage. So we would take indoor furniture square footage divided by the total, gives us 55% times the $45,000, and that tells you of that $45,000, $24,750 would go to indoor, and outdoor would get $20,250. Now we have our advertising, and we're going to do that based on a percentage of sales. So for the departments, we would take, for indoor furniture, they have $180,000 in sales divided by the total sales, means they'd get 36% of the $25,000, and outdoor would get 64%. And make sure you always add those up to make sure they equal 100%, and make sure the total allocated equals the $25,000. That's your check figures. Always want to have check figures. Then we have the $10,000 of insurance based on percentage of insured assets. And we get our $10,000 allocated, $4,000 to indoor, $6,000 to outdoor. Now, which method is better? So let's do a comparison. If we do it based on square footage, more costs go to indoor furniture than outdoor furniture. However, if we do it based on our various cost drivers, it changes. And now outdoor furniture gets more of the allocation. And it seems to me that might be a better way of allocating. The only problem you would have is discussing it with these 2 different departments and getting them to go along with this change. So, since it benefits indoor furniture, they definitely would want to do it, but outdoor furniture would not want to do it, right? Because now they would be paying $6,200 more. So that's the problem with these allocations. And here's the other problem with these allocations, is that when you have a cost center and people don't like how much they're charging, they can go outside. And the problem is when they go outside, that reduces the allocation base, which means the people that are left behind have to absorb more of the costs. This always causes problems. Now, evaluation of investment centers. Duties of the investment center manager, similar to the CEO, is to assess performance. Now, they can use that with ROI, or residual income. Now, ROI is income divided by average assets. It focuses on the profitability by showing how much operating income the division earns on every dollar of sales revenue. For example, if you were to look at these 2, you can see that LCD gets 30% and the phone gets only 20%. So you might want to use that as an assessment of if you want to get rid of a division. All right, let's take a look at an example. We have investment 1 will have sales of $40,000, income of $2,880,000, and their average assets are $16 million. And then we have investment 2, they have sales of $20 million, income of $2,040,000, and average assets of $12 million. Let's use return on investment to see which one is a better investment. So, for investment 1, we get 18%. For investment 2, we get 17%. Personally, that'd be too close to call, because 1%, you got to remember those sales are estimates along with the income. So that'd be a close one to call. All right, now let's look. So, but based on this, we're saying, okay, maybe investment 1, but I'd say too close to call. Now let's take a look at residual income. Determine whether the division has created any excess income above manager's expectations. incorporates target rate of return. Residual income equals operating income minus minimal acceptable income. So, what's minimal acceptable income? It's the average assets times the target rate of return. Now let's take a look at our same example. So, what if the targeted rate of return is 12%? Investment 1 has a residual income of $960,000. Investment 2 has $600,000. Oh, in this case, investment 1 wins. Although they both look like good investments as far as I'm concerned. But again, you have to remember, when we're looking at things like this, companies have limited resources that they can use for investments. So they are presented with investment opportunities all the time, and they have to have some method to assess which is the better use of their money. However, they're doing the whole thing based on estimates. Again, using both ROI and residual income, investment 1 is still the best choice. But what if we had other measures? Well, let's look at profit margin and investment turnover. Profit margin measures the income per dollar of sales. It is shown as a percentage. A high profit margin indicates better use of assets. So it's income divided by sales. Investment turnover measures how efficiently an investment center generates sales from its assets. The higher investment turnover indicates better performance. And that's going to be sales divided by average assets. So let's take a look at our same problem, and let's take a look at profit margin. For investment 1, it's 7.2%. For investment 2, it's better, 10.2%. Now let's take a look about investment turnover. For investment 1, it's 2.5, and for investment 2, it's 1.7. In this case, again, investment 1 is better. So let's take a look at all of our investments. Let's look at all of our ratios and see which one looks better. And I would say still investment 1 looks better. They use their assets more efficiently, and they have a little bit better rate of return, but they also have more residual income. But it's still, that'd be a hard one to call. I think at this point you'd want to look at the management team, because let's face it, they're going to decide whether this happens or not. Now let's take a look at one more problem. We have Mike wants to evaluate 2 of their divisions, dresses and shoes. They want to decide, should they discontinue one? They have a targeted rate of return of 21%. What is the rate of return for each division? So dresses is 30%, which obviously exceeds our targeted rate of return, and shoes is well below. What about the sales margin for each division? For dresses is 12%, but in this example, shoes leaves more dollars on the table. What about usage of their assets? Dresses does a good job, but shoes does not. Now, what about, we've done residual income. Oh, now we have residual income. Sorry, we didn't do that one yet. Okay, and it looks like shoes doesn't generate. So let's do a comparison of all. I think you need to compare all the ratios. And I think if you were going to discontinue any of them, it would be shoes, because they just don't do as well in terms of using their assets, and they don't have any residual income. Although that 21% is a pretty high rate of return. All right, that ends part 1 for chapter 9.